What's up? So conventional wisdom tells us to own a low-cost, broad market index fund and hold for the long term. They say things like time in the market beats time in the market, and to not look for the needle in the haystack, but to just buy the haystack, aka don't try to pick individual stocks and try to beat the market, just own the whole market. Even most experts fail to consistently beat the market. For most people, it is simply not even worth the time, energy, or research to even try to beat the market. And most people simply aren't that interested in investing anyway, so they don't really want to spend the time thinking about it. Honestly, standard market returns can be incredibly powerful over a long enough time horizon. Sometimes it is just better to focus on increasing your income and savings rate and keep the investing nice and simple. Because the total market index fund is so broadly diversified, it can literally be the only holding in your portfolio if you choose. And it can be a buy and hold for life. You can even automate your investing and never even have to look at it if you don't want to. Honestly, it's not a bad idea. Fidelity once did a study and found that the best investors were dead people or people who just forgot about their account. Think about it. Dead people don't try to trade or time the market. Dead people are the ultimate buy and hold investors. Broad market funds are typically passively managed with some of the lowest management costs and lowest turnover. Because they are so heavily diversified across numerous stocks and sectors, they tend to have less risk and volatility than more concentrated alternatives. However, while this kind of diversification limits risk, it also limits upside returns. But what do they mean when they say broad market index funds? Which ones are they talking about? Today we will look at some of the best total market index funds on the market. We will look at things like portfolio composition, costs, performance, and analyst ratings. We have ETFs as usual, but also some honorable mention mutual funds as well. I'll explain the difference, and at the end I'll give my own opinion. If at any point you decide you like this video and find it helpful, don't forget to hit the like button, because that's what it's there for. Also, feel free to lurk down below and check out the links in the description. You can get free stocks, free crypto, and other fun stuff. So without further ado, let's get started. So like I said, we have ETFs and mutual funds. Both ETFs and mutual funds hold portfolios of stocks, bonds, commodities, etc. However, ETFs, exchange-traded funds, can be bought and sold intraday like a stock, while a mutual fund can only be bought and sold at the beginning or the end of the day. ETFs tend to have lower costs than mutual funds. ETFs also tend to be more tax efficient because they have a unique method of doing transactions that provides fund managers with an additional tool to minimize the distributions of capital gains. They can do in-kind exchanges of securities so that the fund is not selling securities for cash and therefore capital gains are not incurred. But I don't want to get too far into the weeds here. Some people like mutual funds over ETFs because they can automate investments and buy partial shares, but pretty much any respectable brokerage allows for the purchase of fractional ETF shares, and some will also allow automating investments with ETFs. In addition to the other perks, I tend to like ETFs more because I like to watch them trade throughout the day, and I like being able to buy whenever I want during the trading day. Although there is definitely a danger with ETFs if you are prone to impulsive day trading, which usually causes underperformance. Bottom line, mutual funds are for boomers, so don't buy them unless you're a boomer. I'm kidding, but also not kidding. Like I said, we have some honorable mention mutual funds on today's list that are very good. But let's look at the ETFs first. First up is VTI, the Vanguard Total Market ETF. This is the most iconic total market ETF on the list. It has a whopping $260 billion in assets under management, and it's a Vanguard product, so you know it's low cost and well managed. Next up is ITOT, the core S&P Total U.S. Stock Market ETF by BlackRock. The $40 billion of assets under management may seem small compared to VTI, but that's a very large number. Next up is SCHB, the SCHB U.S. Broad Market ETF with $20 billion in assets under management. Last is SPTM, the S&P 1500 Composite Stock Market ETF by State Street Global Advisors with $5 billion in assets under management. Okay, so we're going to skip regional exposure as these are all U.S. equities. If you're looking for global exposure, you'll either need to own a world stock market ETF or combine one of these ETFs with an international ETF. I'll probably do videos on these at some point too. Some investors value the added diversification that comes with international equities. Some would rather keep their money domestic. The U.S. stock market has historically outperformed international equities, but that could change at any time. So moving on to market cap. These ETFs differ from S&P 500 ETFs because while S&P 500 ETFs are mostly all large cap, total market ETFs also hold some small caps, but they're still mostly large cap. But they hold thousands of stocks instead of just 500. These ETFs are all roughly 70% large cap, 20% mid cap, and 5% small cap. However, SPTM, having less holdings than the others, skews more large cap. Again, the idea here being that sometimes large caps will outperform, sometimes it'll be the mid caps, and sometimes it'll be the small caps. But you own the whole market and you don't have to try and pick and choose the winners because that's pretty hard to do. Next up is sector exposure. At this point in the video, we are really analyzing these funds as a whole. I don't expect to see many differences at this point. I'm only showing one graphic here because they quite literally are all the same in this metric. So we have 27% tech. Tech is such a large part of the economy. Some of the largest companies in the world are tech companies. Tech has been so strong over the last 10 years, I don't mind being a little overweight in this sector. Everything else is under 13%. Healthcare, consumer discretionary, financials, communication services, industrials. Beyond that, all the other sectors are under 6%. Consumer staples, real estate, materials, utilities, energy, all rounding out the bottom. That's the way market cap weighting works. Very momentum based. You're going to end up with more exposure to the winners, which in this case is tech, but the downside is being overweight tech if tech should underperform. If you don't like that, maybe look for something more equal weighted. Equal weighting prevents you from having too much concentration in just a few stocks, but can be more volatile as they tend to have smaller cap stocks. They also have an inherent buy low, sell high strategy, but also have higher turnover. But I'm not going to act like these funds aren't well diversified, because they are. So we can also take a quick look at more specific industry exposure. But again, it's a little bit of everything. That's the whole point. We have software at 10%, interactive media, technology, hardware, IT, semiconductors, banks, internet, retail, healthcare. The list goes on beyond even what we see here. So let's take a look at top 10 holdings. The point here, again, isn't to contrast the top holdings with each ETF because they quite literally are all the same and roughly weighted the same. But I do want to point out the number of holdings in each. VTI and ITOT have nearly 4,000 holdings. SCHB is around 2,500 and SPTM is down around 1,500. You might think these ETFs would be way different given that some have 1,000 or two more holdings than the others. But 1,500 holdings is more than enough to be strongly diversified, and thus these ETFs tend to trade very closely with each other. 20 to 25% of weight is in the top 10 names for all of these ETFs, which is wild to think given there are thousands of holdings, but again, this is what you get with market cap weighting. The biggest companies get the most weight. And those mega cap stocks really do move the market. So we have Apple, Microsoft, Amazon, Facebook, Google, Tesla, Nvidia, Berkshire Hathaway, and JP Morgan. SPTM has a slightly larger concentration in the top 10 names than the others do. Next, let's look at cost. Sometimes I'm cringing when I'm doing these ETF reviews and I'm covering costs, but that's not the case with these ETFs. They're all low cost, highly liquid, low turnover ETFs. It's beautiful. Each ETF only charges a 0.03% expense ratio. This is the annual fee that we have to pay for management. And in this case, it's dirt cheap. 3 basis points is about as good as it gets. So this is only $3 a year on a $10,000 investment. Granted, later we'll talk about free Fidelity mutual funds. But it's so important to keep fees low because when you lose money to fees, that is lost money that is not compounding in the market for years and years. So it really adds up. Let's look at average spread. Spread is the measure of liquidity and the cost of trading shares, essentially the difference between the lowest ask price and the highest bid price. The lower the spread is, the lower the cost is to trade. Typically, the larger a fund is and the larger the trading volume, the lower the spread. Also, large caps tend to have greater liquidity. The spread for VTI and ITOT is 0.01% and is 0.02% for SCHB and SPTM. So these are all pretty low spreads. And it's not surprising that the larger VTI and ITOT have slightly better spreads, but these ETFs are all very large and liquid. And while this metric is more important for traders frequently moving large amounts of shares, it is something for the rest of us to pay attention to too. Tracking difference is another good metric to look at. Tracking difference shows how a product's performance compares with that of its benchmark over a stated period of time. It's a good report card for how well a manager is doing. It can depend on factors such as expense ratio, rebalancing costs, sampling, cash drag, security lending, and rebalancing timing. Given that fees are included, tracking difference is typically negative. The median 12-month tracking difference for each is as follows. Minus 0.03% for VTI, minus 0.05% for ITOT, minus 0.02% for SCHB, and a perfect 0% for SPTM. So we give the win to SPTM, but these are all great tracking differences. So let's look at turnover ratio. This is the percentage of a mutual fund or portfolio's holdings that have been replaced within a given year. This is most important for investors holding in a taxable account. Funds with high turnover ratios might incur greater costs such as trading fees and commissions and also generate short-term capital gains, which are taxable at an investor's ordinary income rate. In general, we like to hold for more than a year to get the more favorable long-term capital gains rate. The less money we lose to taxes, the more money we get to keep compounding in the market. So we have 8% for VTI, 5% for ITOT, 4% for SCHB, and 3% for SPTM. I'm a little surprised that VTI came in at 8%, but even still, these are all low turnover ratios. I kind of just threw SPTM into this video to make it an even 4 ETFs, but it's proven to be pretty cost effective, and it gets a slight win on turnover ratio. But the tax efficiency of ETFs is definitely something for investors to consider when considering portfolio allocation in taxable accounts versus tax advantage accounts. These ETFs are all tax efficient, so they have no problem living in a taxable account, although they won't be as tax efficient as a strictly growth ETF. But dividend ETFs or actively managed ETFs might be better in a tax sheltered account as they are less tax efficient. Dividends are great and all, but they do make for more of a tax burden. But not tax advice. I covered this in more detail in a dividend ETF video. I'll link it in the description. But speaking of dividends, the trailing 12-month dividend yield for these ETFs is roughly around 1.3%. But speaking more about tax, some people claim to tax loss harvest between these ETFs, but I'm not sure how these ETFs don't classify as substantially identical. Tax loss harvesting is when you sell at a loss to offset a capital gains tax liability. However, you can't take a tax deduction if it is sold in a wash sale. A wash sale is when you sell a security at a loss and buy the same security or one that is substantially identical within 30 days. A better option would be to tax loss harvest between VTI and VOO, because while similar, they are not substantially identical. But again, not tax advice. Consult a tax professional. Let's look at performance. Each of these ETFs has roughly a 43% one-year return, 22% average 3-year return, 19% average 5-year return, and 16% average 10-year return. It's nice that these ETFs have all been around a while, so we have the luxury of looking at 10-year returns. Again, you're not going to get much difference there, but if you want to split hairs, VTI has slightly outperformed the others in each of those time frames, and I mean slightly. This may be because it has slightly more exposure to small and mid-cap stocks. SPTM lags the most over 10 years, but not by much. We don't know what's going to happen going forward, but we know these ETFs will be very similar performance. Lastly, let's look at analyst ratings. Although the analysts don't exactly help us break the tie here, each ETF received an A rating from FactSet and a 4-star rating from Morningstar. So I'm a little bit triggered that they only got 4 stars. They're all 5 stars in my heart. Alright, so this channel is mostly about ETFs, but again, I said I would do some honorable mention mutual funds as well. First up is FIZZROX, the Fidelity Zero Total Market Index Fund that launched in 2018. This is a free mutual fund. There's no annual expense ratio, so you might be asking yourself, what is the catch? Why do they do this? This is what is known as a loss leader, just to get customers in the door, and then the goal is to cross-sell them other products and services, such as other funds or advisory services. So you can only buy this with a Fidelity account. Is it worth switching to save a few basis points of expense ratio? Probably not. And again, I want to reiterate, mutual funds are not as tax efficient as ETFs. So while you can make the argument that FIZZROX is superior to any of the other ETFs when held in a tax advantage account, you can't really make that argument for holding in a taxable account. But to reiterate, FIZZROX can only be held in a Fidelity account, so you can't move FIZZROX out of a Fidelity account without selling. And if it were in a taxable account, this would trigger a taxable event. That is one advantage of FSKAX over FIZZROX. FSKAX is Fidelity's non-free total market index fund, but it can be transferred to other brokerages and bought on other brokerages. The expense ratio is 0.015%, which is basically free. It's a very good expense ratio. And of course, Vanguard has the famous VTSAX, which charges 0.04% expense ratio, but it has a $2,500 minimum to invest. The one thing that I will say is I would never pay a transaction fee to buy a mutual fund. I would rather drink gasoline and eat a lit match. But not all mutual funds have transaction fees. A transaction fee is a flat charge you pay each time you buy a mutual fund, and more commonly if you buy a competitor's fund. For instance, I would have to pay a $75 fee to buy VTSAX on Fidelity, so that's not going to happen. I would never do that in a million years. So what are my thoughts? I think the total market index fund is a great core investment and a real foundation for an investing portfolio. I can totally see why people would just own a total market index fund and not bother with anything else. It's easy, low cost, diversified, and tax efficient. You can just set it, forget it, and never even have to lose sleep over it. At least until you get older and you have to start seeking ways to de-risk your investment portfolio, which is why some people gravitate towards target date retirement funds, because they gradually and automatically do that for you over time, making things even easier. But that's a video for another day. As for me, my core portfolio is in a total market index fund, and from there I take more concentrated speculative bets with smaller amounts of money in other investments. For example, most of my money outside of broad market funds is concentrated in tech ETFs, a few high conviction individual stocks, and also a crypto portfolio. But no matter what happens with those, I have my core portfolio to fall back on, which provides a more steady and predictable growth over a long enough time frame. As far as the ETFs on today's list, I don't own any of them, but only because I get my total market exposure through my 401k and they are not offered there. And again, because these ETFs are almost identical, whether or not you buy one and how much you choose to allocate to it is more important than which one you pick. But if I had to pick, I would want to go with one of the more larger funds with more holdings, so that leaves VTI and ITOT. And sure, VTI has a slight performance advantage over time. At the end of the day, it was going to take a lot to sway me away from VTI just because it's the OG total market index fund and it's a Vanguard. So I'd go with VTI, but I think ITOT is great and the others are good also. But if I were buying in a non-taxable Fidelity account, I might go with FZROX. Like I said earlier, I really do like ETFs more than mutual funds. I like being able to watch them trade during the day, and I like to be able to make purchases during the trading day. In the long run, it really doesn't make a difference if you buy at the beginning of the day, the middle of the day, or at the end of the day. And that 3 basis point cost difference is really nothing, but it just feels good that it's free, because I'm a cheapskate and I love free stuff. But if you found this helpful, consider hitting the like button and subscribe for more content like this. Also consider checking out the links down below. Currently down there you can get 2 free stocks with Webull, potentially valued at $2,300, $30 with M1 Finance, a free stock with Robinhood, potentially valued up to $225, and up to $250 with BlockFi, where you can earn interest on your crypto. However, these promos do change over time. As always, this is not financial advice, just entertainment purposes only. So thanks, and I'll see you in the next video.